Hello, everyone. Welcome to video 2 of chapter 4. In the last video, we calculated our gross taxes payable, and now we get to reduce that amount by the use of income tax credits. So I want to share screen. I mentioned, well, let's go through this slide, and then I will show you a tax form so we can actually kind of take a look at it. Now, there's two types of tax credit. There's refundable or non-refundable. So credits offer you a certain amount of reduction to taxes. A refundable tax, let's say I owe $3,000, and my refundable taxes reduce that owing amount to below zero. Any excess amount below zero comes back to me. It's refundable. I get back those dollars. Non-refundable credits only get us to zero. Once we hit zero, any additional credits are lost. So normally we want to use our non-refundable credits first, get our income down as far as it can go, and then we'll finish it off with refundable credits so that any amounts below zero will actually get back. The thing about refundable and non-refundable is non-refundable taxes, although you lose them once you get to $0, those non-refundable credits repeat every year. So even though we didn't use all our credits this year, we'll get a fresh batch next year. Whereas refundable credits, if we don't use them, if we don't use them to get the refund, commonly they tend to hang around. They can be carried forward. For many credits, a minimum rate of 15% is applied to the tax credit base. So when we're discussing tax credits, there's a separation between a credit base and the actual credit that reduces your income taxes. So credit base is usually our full credit amounts. It's what we're talking about when we say, okay, the basic personal credit is about $16,000. So that base is quite high, 16,000, but it subtracts from your income at 15% of that number. And this 15% applies pretty consistently to a lot of credits. So as we go through the exercises, we'll be discussing credit bases, applying 15% to get you the tax credit. When I discuss base or amount, I'm usually discussing before this 15%. And when I'm actually discussing the tax credits, it's after this 15%. Many credits are gradually reduced as your income grows. So a lot of credits are meant to help low-income individuals. So as your income gets higher, you lose a bit of those credits at a time until it gets so high you don't have access to them at all. And most tax credits are indexed. That's one of the things about we have so many numbers in this chapter to keep track of. And next year, all of those numbers are going to change. Indexed means these numbers increase usually by inflation from year to year. So coming into 2025, all of our index numbers increased 2.7% from 2024. So looking at a 2024 tax return in 2025, you'd notice that many of the credit amounts have slightly updated numbers between the two forms. And some tax credits are transferable to others. Very commonly, we can transfer them to spouse. Perhaps we can transfer them to grandparents or parents, but we'll discuss those as we get to it. So now we're going to go into talking about personal tax credits. But before I do that, I mentioned in the last video wanting to show you, one second, my little video thing is right in front of the tab I'm trying to get to. Here it is. Um, Yes, so this is a T1 tax return. This is the jacket. It's the main page of the tax return. The reason I was highlighting it is in the last video, I showed you that I tried to construct the solution to exercise 1 similar to what the tax form looks like. So if we scroll down past our net income, past taxable income, we calculate a full taxable income, and then this number tells us which bracket we're going to fall into. So if our income was, say, you know, $100,000. We're past that 55, but we're not quite at the 111. So we're still in the second tax bracket. So you notice that these columns function just like you see on that spreadsheet that I'll provide. The non-refundable tax credits, this is a 2024 return, clearly. Yeah. Um, 2024. So the maximum credit from 2024 was 15,705. This is indexed. So in our exercises and examples, I think you're frequently going to see the numbers be about 16,000 instead of 15,000. It's the same credit. It's just been indexed. So right now it's slightly higher. So we have lots of credits that we talk about. There's going to be the basic personal, the age amount. The credit base, the amount is going to go into these boxes, and we're going to add them all together and apply that 15% one time. So since so many credits apply 15%, instead of applying it again and again and again, we use our full amount, we total those up, and we only apply 15% one time with all of the credits it applies to. So when we do our exercises, you'll see this 15%, apply for each of our calculations. But if we were actually filling out the tax return, our full credit base, the 15,705, will go in the box. We'll add the base amount for age, we'll add Canada caregiver, we'll add all the numbers together into box 33,500, and then we'll apply the 15% to that full amount. I wanted to emphasize that because once we get to the midterm assignment, when you're covering chapter 4 and you're seeing stuff about credits, I want to make sure that people are applying, or students are applying, that 15% once, because if you apply the 15% in your boxes, $15,000 times 15% might come to, what's that? 15,705 times 0.15? 2355. So you might put in this box 2355, and then you'll come down here and you'll apply that 15% again. So your tax credit's going to be way lower than it's supposed to be. So make sure you're putting those full base amounts in this upper portion. Okay, now that I've got that out of the way, let's get back to the actual slides and start learning about credits. The first credit that's available to all residents is the basic personal amount. So every person gets $16,129 of basic personal credit base that can apply against income. So our lowest tax bracket applies a federal rate of 15%. That 15% also our credit, our tax credit rate for our credit amounts. So if my income is 16,129, the gross taxes that we'll calculate on that is going to match the tax credit we calculate from the basic personal amount. So what this does is, functionally, for residents of Canada, the first $16,000 we earn is not taxed. That the tax balance that would calculate on it is deducted by the credit, the effective tax credit of basic personal amount. If you have a really high income, the tax credit gets reduced to 14,538. There is a calculation here for how to reduce that difference. And basically, you try to see how far through, I think it's tax bracket 4. So once you're in tax bracket 4, you're losing a bit of that basic personal amount, and it'll be reduced entirely to 14,005 once you get to that highest tax bracket. I'm going to warn you now, or at least just tell you, I don't think we have any questions that's going to trip you up by putting income in that threshold. I think we tend to either keep the income below 177 or just right above 253 instead of having you calculate that difference. But really, just to give you a quick, I don't even know if it's worth the time. I think I just want to focus on the basic personal amounts. Maybe I'll have an addendum or maybe just outline a question or some additional information on how to solve that particular question. But I do want to move on. So for the time being, focus on that 16,129. If you're in the highest tax bracket, your basic personal amount is less than that, 14,538. Okay. There's the prorated calculation. So you find the percentage of how far you are through the bracket and divide by the total range of that bracket. And that will tell you by how much you deduct the basic personal amount. That's my very one sentence summary of it. Again, I don't want to go too far into the calculation because I don't think we throw it at you. So let's focus on spouse or common law partners. The fun thing about the basic personal amount is when there's two adults who are together, who are spouses or common law partners, their household has access to two basic personal amounts. They can save taxes that way. But what if one spouse is working and they earn the income, and the other spouse stays at home and manages the household, so they're not earning income? Well, we want every household to benefit from the basic personal amount. So the basic personal amount that the unworking spouse is not using can be transferred to the working spouse. So this is called the spousal amount. Common law partners are people who are in a relationship, not married, but do live together. They are common law if they cohabitate for at least 12 months or a year. But once they have a child, if they're in a conjugal relationship and have a child together, they're immediately common law. Common law relationship, there's no 12 months waiting period. So if you move in with someone you're dating, after a year, you are considered common law. Um, tax rules that apply to spouses apply to common law partners and vice versa. It's always the two of them. So when I'm going through these credits, I'm not going to consistently say spouse or common law partner. Anytime I'm talking about spouses, I am also talking about common law partners. So if I have a spouse, that individual gets 15% of the basic personal amount. If they're healthy, it stays at the 15% BPA. If they have some sort of infirmity, whether mentally or physically, there is an additional amount that adds to the BPA. This is consistent with the Canada caregiver amount. So I'll go into that treatment in slightly more detail once we get to the Canada caregiver lecture video. But for now, any unused amount. So we have a basic personal amount of about 16,000. Let's say my spouse earned $8,000. So they need to use up their tax credit a bit to cover the small amount of taxes that their income would calculate, and the spouse can be transferred what's left of it. So we take that basic personal amount, the 16,000, minus the net income of the spouse. So the 18,000 the 8,000 that remains can be transferred because the original amount has been used up by the spouse. Now, it's usually claimed by supporting spouse if married or living together. There's no claim if deducting an amount paid for spousal support or for more than one spouse or common law partner. A household is only meant to, I guess to say, benefit from two basic personal amounts. So if I am in a common law relationship with 6 people, I can't have everyone transfer me their credits. I can only have one person transfer the BPA to me. So we only can really benefit from your basic personal amount and the basic personal amount of one additional person, and that's called the spousal amount. But what happens if I'm not in a relationship? What if I have a child, the relationship breaks down, and my spouse and I live apart? Well, because they still want the household to benefit from a second basic personal amount, instead of getting a spousal credit, I can get what is a eligible. There it is. I can get an eligible dependent. So an eligible dependent is most commonly my child who lives with me and is not earning income. So that child can transfer their BPA, their basic personal amount, to my name, and I can use it as if it was a spousal credit. So there's spousal and eligible dependent. Again, you can only get one of these. So if you're getting the spousal amount, you cannot get the eligible dependent. If you're getting the eligible dependent, you can't get a spousal amount. So if the individual is either not married or living in a common law partnership or separated and living apart from spouse. So you and your spouse cannot be living together to get the dependent person. This most commonly comes into play for single parents. If either situation applies and the person financially supports certain family members that are wholly dependent, a credit may be claimed for one such family member. If you have one child, the person who can claim it is really whoever the child lives with. If you have split custody, so the child's with one parent and the other, you guys need to agree who gets the credit. Because if you both try to claim it, neither of you will get it. So they do this so that there's an arrangement at the, usually it's outlined in a separation or divorce agreement to say who gets the benefits. If you have two children and they share households, I might be able to claim one child and my spouse can claim the other child. So again, we want to make sure we're not claiming the same child. It's usually outlined in the separation agreements. But in order to get it, the children must live with you and you must be a supporting individual. So the eligible dependent will be under 18 or mentally, physically infirm or individual's parent or grandparent. So it's either my child, my parent, or it can be an adult, but they rely on me for care. They are dependent upon me. So that's usually adults that have a mental or physical infirmity. This is not usually including aunts, uncles, nieces, nephews, cousins. They're usually looking, top to bottom, parents, grandparents, child, grandchild, but they all must be living with the individual. Related by blood, marriage, common law partnership, or adoption. So it can be my adopted child. If I'm living with my mother-in-law, my spouse's mother, and my spouse isn't working, I can, or perhaps God forbid, my spouse has passed away. If my mother-in-law is living with me, I still have that dependent through marriage, so I can still claim that eligible dependent. Wholly dependent means providing financial support for necessities of life and providing direction, guidance in day-to-day activities. In other words, saying I am active and present in their life. So if I pay someone to handle the care and stuff, then it's probably not to say that they're a dependent person on me. So wholly dependent means I provide the financial support and I take care of their day-to-day needs. So an eligible dependent cannot be claimed if you're claiming the spousal credit, if individuals living with, supported, or being supported by a spouse. So I'm not going to get an eligible dependent because my spouse is still there. I can't claim it for more than one person. And I also can't claim it if the dependent's net income exceeds either 16,000 or 18,816. That's if they include both the basic personal amount and the caregiver. The reason you can't claim it in this situation is because the dependent's using the credits. They have income, so those credits are being used up. They can't transfer what they don't have. If any other supporting person makes the claim for the same dependent, you're going to lose out. If the individual's child, if individuals required to make child support payments for that child. So there might be individuals who say, well, I pay child support, so therefore they're dependent on me. But wholly dependent means it's not just about the financial support, it's the physical taking care of them. So you may be providing child support, but if you don't live with the child, you're not involved in those data activities, so you can't use the dependent person. So only the parent who's living with them. Now they don't if they're living with you part of the time or 50-50 split, then you can make the argument that you are still caring for them in the day to day. But if they have sole custody, if you're not active in the child's life, you can't claim the eligible dependent, even if you are making those payments. So the eligible dependent credit is the exact same as the spousal credit. So the additional amount of 2,687 comes into play for an infirm child under 18. Okay. The next slide goes into the Canada caregiver amount. Canada caregiver is kind of a bigger subject, so I want to leave it for its own video. So let's get to exercise 2. Exercise 2, spousal tax credit. Johann Sprinkle is married, has a 2025 net income of $35,450. His spouse has net income of $2,600. Johann has no tax credits other than the basic personal amount for his spouse and himself. Assuming Johann's spouse does not have a mental or physical infirmity, determine Johann's federal tax credit amounts for 2025. How would our answer differ if the spouse was dependent because of a mental or physical infirmity? Well, here's the spousal tax credit. Johann's income is $35,000. So Johann's income's high enough that he's going to be using his basic personal amount. The spouse's income is $2,600. So the spouse needs to use up at least a little bit of their credits to take care of that small income amount. So the spousal amount is $16,129 minus the income they're using. So 13,529 is left to transfer to Johan. Johan has a credit base of 29,658. We'll apply 15%. So the tax credit will be 4,449, which means we will be reducing our taxes owing by $4,449. So our total credit amounts were almost 30,000. The actual reduction in our taxes is 4,449. Now, this is with no infirmity. If my spouse has an infirmity, meaning some ailment that requires additional care to alleviate or manage, they'll have an additional spousal amount. So we'll take that 16,129, we'll add 2,687 to it, but we're still going to subtract the amount of credit being used by their $2,600. So Johan has his 16,129 from his own BPA. He's got 16,216 from his spouse's BPA and caregiver. So the credit base is 32,345. After 15%, Johan can reduce his taxes owed by 4,852. Please be aware of the importance between credit bases or amounts and the actual tax credits. Okay, so that is our video on spousal credits and eligible dependents. When we come back, we will discuss in more detail Canada caregiver credits. Thank you for your time. I'll see you in the next video.